Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Welcome to part 3 of the latest podcasts from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Now we do have questions from our listeners, so here's Alex Danzig with those questions.
Very good. Thank you very much, John. And very quickly want to thank all of the people who have sent questions in. We're receiving questions from email as well as live on Twitter. We get questions that way as well. And so the first one that I want to cover here is actually coming in from Twitter. For those of you who want to ask questions on Twitter, use the hashtag AskJimRickards. Anytime you do that, we have people who are watching that, and we pick up on those questions, and we can either use them for the current webinar or perhaps a future webinar. The first question from Twitter is coming in from @swapnesh09, and his question is there a sane-headed business school in the U.S. to learn economics, especially macroeconomics, that does not have, I'm paraphrasing this, that he did hashtag no Keynesians, so that does not have Keynesians?
Well, that's a great question. What I advise people when it comes to academic programs, don't focus so much on the school. I mean, you want to pick a high-quality school and a good program, so I'm not saying that all those schools are created equal, but focus on the faculty. Even in a very strong Keynesian school, you can find individual faculty members who are, a little more market-oriented or using what are called heterodox or other, maybe even Austrian economics and so forth. So I would sort of take an a la carte approach and look for professors, and then when you show up at that school, take your macro courses. They're all going to be the same. Then, kind of get acquainted with that professor and try to take advantage of the opportunity to learn. Now, in terms of a school, I would look at George Mason University in Virginia. It's a fine school, but George Mason is well known as having an economics department that is more Austrian-oriented, more free market-oriented. So that's one that I think you can get a breath of fresh air. My problem when I studied economics in college, I got a graduate degree in international economics. That was a specialty, but as an undergraduate, I studied economics, and I had a hard time. I mean, my grades were okay, but I really, really struggled with it, and I just thought that I wasn't very good at it. It was only decades later that I discovered that the reason it made no sense was because it made no sense, and I was trying to struggle with something that really didn't make sense, and I can see that now, so I feel a little bit better about my academic performance. But at the time, I was taking it seriously, and I didn't understand that the whole sort of neo-Keynesian way that economics was taught, which, by the way, does not have a lot to do with John Maynard Keynes. I mean, I'm kind of a fan of Maynard Keynes. I'm just not a fan of Keynesianism, but Keynesianism was hijacked by Paul Samuelson and the faculty at MIT in 1947. And what was taught in the 50s, 60s, and 70s, and even today as Keynesianism, I don't think Maynard Keynes, if he were alive, would even recognize it. So I can say a kind word for Keynes without being much of a fan of neo-Keynesian economics. But the only two things I would say are number one, look for faculty rather than schools. And I do think that George Mason University is one that I happen to be acquainted with that is a fine school and a good economics department. I wouldn't rule out Harvard. I would just sort of go through the academic brochures and try to find a good professor. Interestingly, Joseph Schumpeter taught at Harvard throughout the 1930s. He's one of the most famous economists of the 20th century. Trained at in the Austrian school at the University of Vienna, was classmates with Ludwig von Mises and others. So kind of a dyed-in-the-wool Austrian economist, but he was on the faculty at Harvard. So I don't think we can ding Harvard. You sort of have to like I said, look for your individual faculty members. Another place we should widen the aperture a little bit. I think the London School of Economics is they've got their share of Keynesians, but I think you'll find some good heterodox economists there as well.
Okay, very good. Really glad you pointed out the difference there as far as what the difference between what Keynes taught and how it's kind of been hijacked today. I know Keynesians get picked on quite a bit in certain circles, and I think that's really important to point out those differences there. Going back to a little bit earlier, something that you had mentioned as far as gold doing really good in the euro and not necessarily measuring it in the U.S. dollar, I just pulled up a chart and looking across the board, yeah, that's absolutely correct. In the euro in 2015, it was up 9.4% and up over 3% in most other currencies. And across the board, 2013, there was a pretty big pullback, but the average for the last 15 years in virtually every major currency is higher than 7%. Agree with you there again. It just depends upon how you're measuring it. So next question that's come up here is coming in directly on the webinar, and this is coming from Sean F. And the question is, with bail-ins a certainty and a stock market meltdown a significant possibility, where should you put your cash? And then the next question is physical gold. I guess he's asking physical gold, or where else would you put it?
I will answer that question, but before I do, I just want to drop a footnote, because I obviously say a lot of favorable things about gold. I invest in gold myself. I manage a fund that has gold on the board of advisors to the Physical Gold Fund, which offers a solid gold fund. And it was a fund that you can invest in where it's completely backed by physical gold, that you can leave it in the vault, or you can have it delivered. You can have it converted to cash. It's a very well thought out plan. So obviously I'm an advocate for gold, both as an analyst, as an investment manager, and as an advisor. But I've never said, and I'm not going to say now, sell everything and buy gold. I don't believe in going in 100% into anything. I think the right allocation for most investors is about 10%. If you want to be aggressive and lean in a little bit, okay, go to 15, 20% if you like. I don't recommend 50%. I don't recommend 100%. I think it's foolish, no matter how much you like an asset category, and I do like gold, to go all in. Because I get beaten up all the time. I say, I will say something good about gold, and then somebody will say, well, gold went down, you're an idiot, whatever. I said, no. If you have a 10% allocation and it goes down 10%, you've only lost 1% on your portfolio. No one likes to lose money. I mean, that's no fun. But 10% of 10% is only 1%, and that's part of the reason for diversifying. So, yes, I do think gold is a good place to put liquid assets. Gold is also funny in the sense that it's liquid and thinly traded. Now, that's a very unusual combination. Usually things that are thinly traded are illiquid. Let me just describe the difference. Thinly traded means that the volume of trading relative to the volume of the stock of whatever asset it is fairly small. Maybe the number of dealers is fairly small, etc. And saying something's liquid means that you can get it in and out of the market with relative ease or a minimal market impact. You're not going to upset the market or have a hard time. Like if you try selling a private equity fund or shares in a venture capital company or some other assets, you're going to have a very difficult time. It's not that it can't be done, but that's illiquid. But you'll never have problems buying or selling gold, but it is thinly traded. So gold is a funny kind of market where you can get in and out with relative ease. I've never seen a situation where there wasn't a bid for gold or where you couldn't buy the gold if you wanted. But there's not that much gold that's actually traded. So I do recommend for investors kind of 10%. I think that's the right amount. If you've got 2 or 3%, you might think of increasing your allocation. If you've got 50, it's a little too much for my taste, but to each his own. So there's a place for cash, there's a place for gold, there's a place for, I even own some stocks in private companies. I don't think they're liquid. If I have to pay the electric bill tomorrow, I'm not counting on my venture capital investments to be able to pay the bills. I've got to have cash for that. But it has a place in my portfolio. So I think diversification is the key. But given the possibility of a stock meltdown, which I think is a real one, by the way, I can see stocks falling a lot, meaning, at least 20%, but maybe 30 or 40% in a short period of time. It doesn't mean one day, although it could happen that way. But, even over a couple of weeks. The funny thing about stocks falling 30%. Let's say they fall 30% in 3 weeks, just to pick an example. So it goes down 3 or 4% in one day. That's a big drop, and people go, "Oh, okay, I'll buy the dips," and then they buy more, and it goes down 5% the next day. And I'm like, "Huh, maybe I'll buy more. Maybe that wasn't such. I'll sit tight because I know it'll bounce back." And it goes down, 4% the next day. I was like, "Wow, this is really getting ugly. We're getting into bear market." And the point is, you say to yourself, "I never would have sat there and watched it go down 30%." But that is actually what people do. They do sit there and watch it go down 30% because they're in denial about what's happening. They're watching these 3, 4, 5% drops day after day, and the whole time they're telling themselves, buy the dips, it'll come back. I just need to sit tight, don't panic. Everyone on television saying, don't panic, or whatever. Next thing you know, it is down 30%. You're like, wow, what happened? I just got wiped out. That's human nature. It's very hard to fight human nature. The best traders I've ever met, worked with people like Bruce Kovner and others. They have ice water in their veins. They are very unemotional. Something goes down, boom, they get out and, get a good night's sleep. And maybe you come back in the next day, but at least you've cut your losses there. So, yes, I do think stocks are very vulnerable. By the way, when I say stocks are vulnerable, they're very dangerous. Stocks could actually be higher at the end of the year based on the fact that the Fed is going to blink. The Fed's not going to cut interest rates, and the market kind of expects a rate increase, and when they find out they're not going to get it, that's the psychological equivalent of a cut, and stocks could rally on that. So I'm not saying stocks are going to go down 30% tomorrow. I'm just saying they might. I actually think stocks will be higher but at the end of the year, but I still don't like them because I think it is a bubble and I think it's too dangerous. So banks, likewise, I think that in a financial panic, you're very vulnerable to getting locked down, a la Cyprus, a la what will probably happen in Greece. So you don't want all your money in the banks either. So then you say, well, okay, gee, if the stock market's too risky and the banks are going to get locked down, other than, a little bit for walking around money, what should I do with my portfolio? And it's a hard question. I understand that, but I do think a 10% allocation to gold is a very good place to put some of your wealth where the wealth will be preserved. It won't be locked down. It'll maintain its value. And, if you need to sell it, you can.
Okay, a quick point of clarification. This is coming from Leo H., and he's asking, Jim, when you say 10% allocation to gold, is that 10% of your liquid portfolio, meaning stocks, bonds, cash, or 10% of net worth, including, for example, home equity?
Yeah, really good question. I'm glad that was asked. That's 10% of your investable assets, so it's called your liquid portfolio. I always say take your home equity and take your business. If you're a small business person, maybe you have a restaurant or a dry cleaner or a pizza parlor, or you're a car dealer, or you're a doctor or dentist, whatever that is, however you make your living, if you have some business capital, put that to one side, put your home equity to one side, and whatever's left, those are your investable assets. And I recommend 10% of that, 10% of your investable assets. But do not, or at least I'll speak for myself, I don't recommend, going out and taking a home equity loan and taking 100% of your home equity and pouring it into gold. I like gold for all the reasons we've talked about, and some more that we haven't had time to get to on this call. But gold is volatile. That's just a fact. It's volatile in dollars. See, I think of gold as constant. I don't think of gold as moving around. I think when I see that people say gold is up or gold is down, what they mean is that the dollar price of gold is up or the dollar price of gold is down. And when I see that happening, I say, well, gold is constant and the dollar is bouncing around. So, if the dollar gets strong, the dollar price of gold goes down. If the dollar gets weak, the dollar price of gold goes up. But to me, it's not gold that's moving around, it's the dollar that's moving around. That's how I understand currencies and the currency wars. I think of gold as kind of a constant store of value and a constant store of wealth. But that's me. But having said that, if you're measuring in dollars, if dollars are your numeraire, then gold is volatile, and leverage is volatile. So you don't really want to put volatility on top of volatility. You don't want to be a leveraged investor into gold. You want to put money into gold that is your money, your wealth, as an allocation. So so put your home equity and your business equity to one side. Whatever's left, those are your investable assets or your liquid portfolio, and I recommend 10% of that for physical gold.
We get a wide range of people who come to these webinars, everything from students to business owners to managers of substantial funds and institutional money managers. This next question is coming from a business owner. His name is Brad C. And his question is, as a business owner, I often wonder if I should continue reinvesting in my business versus increasing my hedges against certain financial disaster in the future. My business depends on customers' ability to spend, and given that the future isn't looking so good, would Jim recommend keep reinvesting free cash flow back into the business or use those funds to keep building a financial moat, so to speak? Thank you, Brad C. from Washington, D.C.
Brad, thanks for the question, and I appreciate it. But I mean, to be completely candid, I'm just not in a position to answer that. I get all kinds of questions all the time, whether it's a webinar like this, which I thoroughly enjoy doing, or I'm on live TV or live radio or print media or whatever. So I'm not shy about answering questions, but I'm also careful to stick to what I know and not try to be, the shell answer man for every question that comes up. I just honestly, on a call like this, it's impossible to know enough about your business to give advice like that. So I'll refrain from doing that. The only thing I would add is I don't know what business you're in, and some businesses do well in tough times. But I do see the U.S. economy as as I said earlier in the call, it's flatlining right now, and the prognosticators say, well, the Fed says we have to have 3.5% growth, so I guess they mean if it's going to be 0 in the first half, somehow it's going to be 6% in the second half, and that'll average out to 3%. I don't see that. I mean, something like that did happen last year. Go back to 2014. The first quarter was negative. The second quarter was positive. The first half, was flat. But the second quarter was positive. The third quarter was gangbusters. The economy grew 5% in the third quarter of 2014, and that's when the Fed got the crazy idea that we could somehow afford a strong dollar and let the euro crash, which it did. But that was, and I said this at the time, that was a bogus number. In that 5% for the third quarter, the Commerce Department failed to make the seasonal adjustment for defense spending. That's a really big deal, because if you know anything about defense spending, and I actually do because I do some consulting for the government in the defense intelligence sector, the government's on a September 30th fiscal year. The government doesn't use a calendar year. I mean, why would you do that? It's too easy to understand. So the government's on a September 30th fiscal year, which means, the year's over September 30th. So if you're a contracting officer in the Department of Defense or, some other agency, and first of all, you don't even get your congressional approval, your authorization to spend money probably till February. So the whole period from October 1st to February, the following February, is frozen in time because they haven't approved the budget. Then, around February, they get around to approving the budget. So now you only got 7 months left in the year. But even then, the contracting officers don't do anything because they like to keep their options open. If they sign a big, billion-dollar contract for something, that means if a better idea comes along, then too bad, you already spent the money. So they wait until June and July. But then you can't wait too long because it takes 30 days to sign a contract. So you got to get them all done by August if you're going to lock it in for the fiscal year. And believe me, they spend the money. It's like use it or lose it. Nobody ever gives money back to the Treasury. So what that means as a practical matter is that the lion's share of defense contracting gets done in July and August versus the rest of the year. And that's why the Commerce Department makes a seasonal adjustment to kind of smooth that out. But they didn't do it this year, and that was to, I think, pump the number, because that third quarter GDP number came out right at the end of October, just a couple days before the election. So it has the look of the White House wanting to, kind of goose the election in their favor by coming out with a blockbuster GDP. Well, they did that, but when I saw it at the time, I said, well, okay, you can play the game, but you're going to pay for it. That if you put too much spending in the third quarter, it's going to come out of some other quarter, and sure enough, it did. Fourth quarter was dropped significantly. First quarter is 0. Looks like it's going to be revised negative late next week, or 2 weeks, and then second quarter indication close to 0. So we've had to pay the price. So I see the U.S. economy is very weak. Again, I don't want to give individual business advice because I just don't know enough about it. But if the broader question is, how's the U.S. economy doing? The answer is not too well.
We've got a couple of minutes left, and as usual, we've got way more questions than we have time to answer. So thank you to everybody who's sent questions in, either through Twitter or by email, or also online live during this webinar. I'd like to, if possible, try to squeeze a couple more in here. The first one is a really interesting question, and it's kind of appalling to me that we even have to talk about this, because I think everybody already knows the answer, but we still need to talk about it. As people, I think we still need to talk about it. This question is coming from Juha M., and the question is it possible that central banks can prevent stock market crashes infinitely by buying up stocks every time there's a severe correction to the downside?
The answer is no. They can do it for a while. First of all, the Federal Reserve so far has not bought stocks, at least not publicly traded stocks. They bought some hodgepodge of crummy assets from Bear Stearns when they bailed out Bear Stearns in March of 2008. But other central banks can buy stocks, and some of them do. They can buy derivatives. They can buy stock futures. So there is some capacity to prop up markets. The Fed has other ways of propping up the stock market without buying stocks. One of them is zero interest rate policy. They just say, I once got a phone call from a retired lady in her early 80s in Florida, and she said, I have $100,000 in the bank. That was kind of her life savings. And, she had some Social Security and retirement benefits and health care. She wasn't impoverished, but that money was kind of all she had in the world. And she said, I used to get, $2,000-$3,000 a year interest, even at 2 or 3% on $100,000. And she said, that paid for my meds, and now I get zero, and I'm having to do without my meds. What can I do? That was sort of her question. It was a sad state of affairs. Well, this is what Janet Yellen's zero interest rate policy gives you. It steals money or takes money from savers and hands it to the big banks, hands it to Jamie Dimon and people like that, because if the bank's not paying you anything, you're not getting any interest on your savings account. Well, who wins? Well, the bank wins, because they get to use your money for free, and they get to lend it out to somebody else and make it spread. So the whole zero interest rate policy is taking money out of the pockets of savers and handing it over to the big bank. So that's what has been going on. Now you say, well, wait a second, that's really unfair. I got to get some return. What can I do? And Janet Yellen will say, buy stocks. They actually have a technical name for this. It's called the channel effect. The channel effect is we, the Fed, wants you to channel your money into stocks. So over here, you want to put money in the bank? Well, we'll pay you zero, and the portfolio channel effect. The idea is that if you want to return, you'll go buy stocks. So by having a zero interest rate policy and paying savers nothing, the Fed is in effect forcing you to go into the stock market to buy stocks if you want to return. So Janet Yellen's answer to this 82-year-old lady in Florida would be buy stocks. Of course, my answer is don't even think about it. You're 82 years old. That's all you have. If the stock market goes down 30% in a short period of time, you're going to be wiped out. So you have no business being in the stock market. Maybe if you're younger and for a portion of your portfolio and you have a long-term view, that's different. But if you want to take that risk, but not for someone in that position. So that's how the Fed props up stocks, basically through this portfolio channel effect and the zero interest rate. But the question was, can they do it indefinitely? The answer is absolutely not. Something will break. Don't know exactly when, don't know exactly where. I could identify a range of possible dates and a range of possible triggering events or catalysts. I'm not saying we have no idea. I'm saying we actually have probably quite a few ideas, but it's hard to know which one. My estimate is sooner than later, meaning, could it be 2017, 2018? Yes. Could it be tomorrow? Yes. And is something that will erupt in emerging markets or China or the oil patch, fracking junk bonds, geopolitical risk? Yes, it could be all of the above, but it doesn't matter. What matters is you can see it coming, and you can do prudent things in advance to preserve your wealth. But there will come a time when the magnitude of the catastrophe will be greater than the capacity of central banks to bail it out. That will be an interesting time because, just go back over recent times. In 1998, Wall Street got together and bailed out a hedge fund called Long-Term Capital Management. I happen to know a lot about that because I was at Long-Term Capital Management and I actually negotiated that bailout. But global markets were hours away from shutting down. That's not an exaggeration. That's actually something that Alan Greenspan and Bob Rubin testified to, and I was there, and I can verify that that's a a true statement. So global markets were hours away from shutting down, and Wall Street bailed out a hedge fund. In 2008, 10 years later, the central banks bailed out Wall Street. And again, markets were, if not hours, then just days away from shutting down. So in 1998, Wall Street bailed out a hedge fund. In 2008, the central banks bailed out Wall Street. Go ahead 10 years to 2018. Who's going to bail out the central banks? What's bigger than the central banks? Well, there's only one thing in the world bigger than the central banks. That's the IMF. And that's where this world money, the special drawing rights come in. So there comes a time when you keep, it's not kicking the can down the road, it's kicking the can upstairs to a higher authority. But there is no higher monetary authority than the IMF. And so when that bailout comes with SDRs, that will be highly inflationary. But at that point, people might lose confidence in all forms of paper currency, and then that's when gold will be the only safe haven.
Okay, very good. And that pretty much does it for our time available today. So, Jim, thank you very much, and as always, and thank you for your insights. And with that, I will be handing it back over to John.
Well, thank you, Alex. And let me remind our listeners, you can follow Alex Stanczyk on Twitter. Just go to Twitter, type in Alex, then Stanczyk, that's STANCZ or ZYK. Great insights and valuable links to follow there from Alex. And thank you, Jim Rickards. Always a pleasure and an education having you with us. First of all, thank you to our listeners for spending time with us today. Of course, you can also follow Jim on Twitter. His handle is @JamesG.Rickards. So goodbye for now, and we look forward to joining you again soon. You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.